All right, welcome everybody to another State of the Market. I'm Seth Golden, and this is Finom Group, and we've had some wild price action this week. We've got the NASDAQ trending now after closing below its 50-day moving average. It's decided to, do some additional legwork to the downside, and today is trading below its 100-day moving average. So far, the NASDAQ has corrected from peak to trough here about 11.5%. The S&P 500 has also corrected just about 5% as of today. On the year now, the S&P 500 is just about unchanged. Just about unchanged, right around 3750. And with all this wild price action, investors, are looking for some rationale and, conditioning for, the potential rebound in the future and where that rebound might come from. Not in the business of calling tops or calling bottoms, but, driving home an investing process, an investing and trading process. One of the things that we talked about last week was the impact that rising yields, rising rates are having on the whole equity risk premium equation and lending itself to more selling activity. We've been down 2 weeks in a row in the S&P 500, and it looks like now we're going to be down 3 weeks in a row, depending on how the afternoon trading goes. We are coming to you live today with our inside of our trading room, delivering the weekly state of the market. I know that a lot of our members, our contributor members, our premium members, our mastermind option trading members, can't be inside the trading room every day because you're working or you're taking care of kids or you have another life. So I thought this would be a good idea, to come live, record live during the course of the trading day. And this is what we're looking at right now, folks. We're down 203 points at the lows of the day here in the NASDAQ. S&P 500 down 17. It's getting hairy, as they say, but we keep getting these bounces here on the day. And it wouldn't surprise me if, that we continue with this up, down, but we keep making lower lows. Also, you got to factor that into your, swing scalp type trading regimen. We're making, new lows here at 11 o'clock in the morning Eastern Standard Time. With that being said, again, it all comes down to have a game plan. Remember, when stocks go on sale, you go rushing in. You shouldn't go rushing out. You should go rushing in with that shopping list that you have of the stocks or the ETFs that you want to buy. All right, so let's get down to the nitty gritty. We're going to look at some studies. We're going to look at some charts, and we're going to kind of make sense of what's going on in the market at this time. Here's, something that I was looking at, and this goes back to March of last year when things were really bad in the market. And I saw this from Dean Witter. This is his quote back in 1932, just before the end of the worst bear market in history. He says, some people say they want to wait for a clear view of the future, but when the future is again clear, the present bargains will have vanished. In fact, does anyone think that today's prices will prevail once full confidence has been restored? Like everybody, I'm going to wait for cheaper. I'm going to wait for cheaper. I'm going to wait for, whether or not we're going to pass the next round of fiscal relief. I'm going to wait for, COVID to get to herd immunity. I'm going to wait for jobless claims to start trending lower for at least a good month. And I want to see a 10% correction, not a 5%. Like everybody, puts off. They seem to put off buying for one reason or another. Those are the people that don't really have a game plan. They're just reacting to price or not reacting to price with a predetermined game plan. And I think that's, we can extrapolate that from this quote that Dean Witter offered back in 1932. And this was basically at the end of the worst bear market in history. But you want to buy when there's blood in the streets. By the time you wait for things to get clear, the best prices will have already been gone. Don't get me wrong. There's nothing wrong with, chasing when you have some degree of certainty. But if you're looking for better prices, it's not the best discipline. You should already have a game plan that is kind of irrespective of, how cheap something has to get. With that being said, here's some rules to follow when it comes to, riding the trend. Folks, even though we are down, like 5% on the S&P 500 from the top, and a little more than 11% for the NASDAQ from its peak here earlier this year, we're still in a longer term uptrend. This is a new cyclical bull market. Know how to trade and invest in the trend. It doesn't usually pay very well to be contrarian against a strong trend. What is the market telling us about future returns? Now, we've looked at this chart now for a good 3-4 weeks. This was, this goes back to the first week of February, where the S&P 500 was up Monday, Tuesday, Wednesday, Thursday, Friday. It's a perfect week. It's happened 19 times prior to that. This was the 20th. 1 week later, positive returns, but only 58%. 2 weeks later, here's where we are this week, folks. Now, in order for this, from the date of the signal, we were at 38.86 to end that first week of February trading, 38.86. Well, if we're going to get a 0.5% return on average when this signal throws, we would need to get to 39.03 a month later, the 1 month return. And we did that. We did that this week. Now, we've since faded, obviously, and given back everything and then a little bit more on a year-to-date basis. But, this is one of those studies and statistics that we've looked at with a decent sample size, now 20. And it came to fruition. We got to 39.03. The average return was achieved. What's going to be 3 months later? Well, we're supposed to be up 3%, and that's from 38.86 on the S&P 500. So we're going to keep this around and see if it lives up to the hype. Again, this is the average return. This is a study that is not coming to fruition. Again, just about the same time back in early February, this particular signal was telling, this was on 2/12 actually, second week, started the first week of February. We had 9 days in a row where the value line geometric index was higher. 1 week later, which would have been the third week in February, we were supposed to be positive. We were not positive. The final week of February would have been 2 weeks later. We were supposed to be 100% positivity rate, by the way. We were negative. 1 month later. So we still have yet another week to go to see if we'll be up 2.33% from this signal date. But so far, this study is not panning out for us. Again, this is 9 days in a row, a 9-day winning streak for the value line geometric index. We're throwing a monkey wrench into things here, folks. So, and this has happened 44 times in the past. So it's not like it's a small sample size. This is a pretty significant study. What I will say, though, even though this has failed on the more near-term forward-looking returns, the longer you go out in time, the greater the probability that you will find the signal working or the signal delivering the expected returns. All right. Well, it is the first quarter. The first quarter, this is a quote or a tweet, if you will, from Ryan Dietrich. The first quarter of a post-election year is actually one of the worst quarters of the entire 4-year cycle. Sell the news after the election, maybe? So you can see, and it's not like it's a terrible quarter. We still have another 3 weeks to go, 3 trading weeks to go after today, Friday, in the quarter. And again, we're basically flat on the year. We'll see where we end up, after today, of course, but let's call it flat here at, noon on Friday. And the typical return for the first quarter after an election year is negative. However, and we've been looking at this particular study as well. A peek into January, which did not work out, by the way. This study is basically if the average return, if the previous year had an above average return, which we did, in 2020, we had almost a 16% return, including the dividend, the S&P 500 dividend. That's an above average return. The average return is about 7.5% going back to 1928. So we had an above average return. Typically, January tends to deliver an above average return as well. It did not. We were down. We were down in January. But we were up in February, so a little bit of flip-flop there. However, we still are using this particular study because it also relates to if the prior year had an above average return, the first quarter can be much stronger after an above average year. So we're still in the first quarter. The average return after an above average return year is 2.15%. So this is still in play, although this didn't work out. The January, return didn't work out for us. We're still in the first quarter after an election year. Who's going to win? Is it this additional data point, coming out of not just an election year, but an above average return year? It's an additional data point to consider that's not really taken into consideration here in the Ryan Dietrich tweet or study. But we'll see. Is that additional data point that relevant? We're going to find out come, the end of March. Everybody's all hyped up about the yield curve, about rates rising, and, the equity markets trying to figure out where value is now that bond yields are more attractive, right? I mean, at some point, we are going to find a demand equation now that bonds are around 1.5%. And speaking of the 10-year yield. But the reality is when bond yields are rising, when rates are rising, as long as they're doing it in keeping with the strength of the economy, the market rises with it. It's just a matter of the rate of change right now in the 10-year yield is concerning for market participants, equity market participants. And we typically do see a hissy fit when that happens. And it usually does coincide with, lo and behold, a new a cyclical bull market. Having said that, this particular study that we've also been, looking at ever since the yield curve, signified by the 10-year minus the 2-year, crosses 100 basis points. And so if we go now really quickly here to our 10 minus 2s, we first got above 100 basis points, it looks like. Yeah, we'll call it right there. Here we are. January 29th, right? The very end of January, basically. And that, I think the final trading day of January was January 30th. But from that point, I guess we should go to the S&P 500. We're going to look into this study in real time. Oh, too slow. Let's get some of these off of here. There we go. Get some of these lines off of here so we can look at it more cleanly. Boy, Yahoo Finance is having some problems. I know it can do it. Let's try it again. There we go. All right. Come on, work with me. Okay. Here we go, January. Get to the 29th. That's a big candle there. All right, here we are. Closed 37.14. January 29th. We're up 25 points from then. We're up 25 points from the day where the yield curve crosses above 100 basis points, right? Got 100 basis points. Right now, we're at the steepest we've seen the yield curve since November of 2015. Very steep. Is this sustainable? In my opinion, no. You look at the 10-year chart of the yield curve, clearly you get these, rounding patterns here, but they ultimately fade. Rounding pattern here, ultimately fades. Rounding pattern here, ultimately fades. In my opinion, this will also ultimately fade. Speaking of trends, that trend is your friend. And also, in my opinion, to the degree that we hear people say, oh, the financials, the banks, they're going to lead. After lagging for 10 years, they're finally going to lead. Well, yeah, they're going to do better when you have a steeper yield curve. But clearly, the steeper yield curve does not persist. And I think that's, part of the equation that a lot of analysts are missing with respect to suggesting that, financials are going to lead over even tech. All right, I think there's a lot of prisoner of the moment at this time, nonetheless. So, after we went on January 29th, a month later, clearly we did quite well. Remember, we were up about 5% at one point in the month of February. And the average return a month later is 4%. We overachieved a little bit. 3 months later, when we've crossed 100 basis points on the yield curve, we're up 5.5%. So that's in play. That's in play next. But again, talking about rising rates, talking about a yield curve steepening, these are good things longer term. The problem is in the here and now, when you have the 10-year yield change so quickly in a month, this is 89 basis points. You have the market to have a little hissy fits when you're moving that quickly. And, just recently we saw that during the last month, the 10-year yield has risen by 50 basis points, which is a 2.6 standard deviation. Equities typically struggle when treasury yields rise by 2 standard deviations. Rolling 1 month S&P 500 returns are not good. Again, it usually coincides with a new bull market cycle, and the bond market is trying to price in some type of economic expansion, some type of rate of growth in GDP, and at some point that stops. It gets validated. Are we there for this particular cycle? Well, we'll know in hindsight. But there are some trappings that I think we've seen today suggesting that we may be in this topping pattern with the 10-year yield. A lot of people are referring to this current fit, in the bond market and the equity market with what we saw in 2013, previously referred to as the taper tantrum, right? We all remember the taper tantrum back then. But in comparing today with the taper tantrum back then, or the rate of change back then in the 10-year yield, we can see in this chart right here from UBS, the change in the 3 weeks from February 10th to the date of this chart, which was just last week, 35.4 basis points. Back in 2013, it was only 25. So this is much greater volatility in the bond market, much greater volatility in copper versus 2013, much more volatility in oil than in 2013. High yield credit spreads had more volatility then than they do now. And we can see this also show up in high yield credit spreads. So while we're seeing the equity market down, well, we rose 2% on Monday. We gave 2.3%. We've given all of that back here over the last 3 trading sessions. And yet high yield credit spreads have literally risen 0.03 of a basis point. That's it. That's it. The credit market is basically saying, I don't care what you do over there in the bond market. I really don't care what you do in the equity market. we're fine. There's no widening of credit spreads. This is also a key signal in determining it. It should be a signal to investors that when you get these pullbacks in the market and high yield credit spreads are not widening out, you do not have an inverted yield curve, but we actually have the steepest yield curve that we've had since 2015. Buy the dip strategically in accordance with a predetermined game plan. But these are your cues, folks. These are telling you that what's happening, between that relationship with bonds and equities is just transitory. They will find an equilibrium. Investors will recognize value. It's just a matter of working through these, this machination, if you will. So high yield credit spreads were much more, wider or more volatile back in 2013 than they are today, which also speaks to Fed policy. So at the start of this weekly State of the Market, I had mentioned, our report from back in March 2020, which consisted of that Dean Witter quote. Here's the actual week that the market bottomed. March 23rd was the ultimate bottom here. We were down that day 2.93%. Tuesday, look at this rally, folks. 9%, 1%, 6%. Guarantee you folks said, we're going to short here. Rip your face off rally once again. And we ended the week on a down note. But for the whole of the trading week, we were up pretty sharply. When the market is down or generally volatile, it's bad. It doesn't matter when it happens, it's still just bad. The chart of daily returns above was from the final week of March 2020. In that moment, it was still bad, even though we were, chopping around here and, producing some nice gains. It was still bad, although improving. Why was it improving? And for those of you who remember that time, that was when the Fed was coming out signaling that they were going to take rates to zero. They were going to start the QE process once again. It's simple. As an investor, it's simple. When the Fed gives you that signal, you don't fight it. You just don't do it. Here's what we wrote in our weekly research report back then, hearkening back to the Fed's monetary policy actions and rate actions from all the way back in World War II. In 1942, everybody knew it was a whole new ball game. And it sure as hell was. Uncertainties, right? We were all in a war that we were losing. The Germans had overrun France. The British had been thrown out of Dunkirk. The Pacific Fleet had been disastrously crippled at Pearl Harbor. We had surrendered Bataan, and the British had surrendered Singapore. The U.S. was so ill prepared for the war that the cavalry school at Fort Riley was still teaching equestrian. And I would guess that probably 75% of our field artillery was equipped with horse-drawn French 75 millimeter guns, model 1897. So with all of that negativity, all of that bad, it's just bad, it's bad. On Saturday, April 11, 1942, the Wall Street Journal stated, brokers are certain that among the factors that are depressing potential investors are widening defeats of the United Nations, a new German drive on Libya, doubts concerning Russia's ability to hold when the Germans get ready for a full dress attack, the ocean transport situation with the United Nations, which has become more critical, and Washington is again considering either more drastic rationing with price fixing or still higher taxes as a means of filling the inflationary gap between increased public buying power and the diminishing supply of consumer goods. Yet, remember the date. Here we were. This is April 13, 1942, just a couple days after the Fed stepped in and fixed rates The 10-year was capped at just about 2%. And the market took off basically for the next 2 years. Finally, in 1944, had a little bit of a correction, but just kept going into 1946. Don't fight the Fed. The guys that print the money are telling you they're going to keep their foot on the gas. On April 28, 1942, in that gloomy environment, in the midst of a war we were losing, faced with excess profits, taxes, and wages, and price controls, shortages of gasoline and rubber and other crucial materials, and with the virtual certainty in the minds of everyone that once the war was over, we'd face a post-war depression in that environment, the market turned around. When the Fed steps in, you need to be on the side of the Fed. I'm continuing, to look at yields and whatnot, and the market, how the equity market performs, because we had an extremely robust, market performance given the dynamics last year. We were up 16%. And that's double-digit returns, folks, 2 years in a row. Let's not forget, in 2019, the market was up 31% on a total return basis, 16% last year. But this is a new, This is a new bull market coming out of a bear market low, where we've completed year one here in March. We're pretty much done. At the end of this month will be officially the anniversary of the bear market low. The second year off of a bear market low, the average return is 12.7%. The max drawdown on average is 9.8% in the second year. You've had bigger drawdowns, of course, 14%, 17%. You've also had smaller drawdowns, 8%, 6%, 6%. But the average drawdown in the second year, post a bear market low, is 9.8%, with the second year average gain 12.7%. If we are using the 2009 to 2010 analog for 2020 and 21, in 2010, the S&P 500 was up 13%. So there you go. This chart right here comes from Tom McClellan. We have this head and shoulders, or we have a couple of head and shoulders patterns that have developed on the NASDAQ, but they've resolved higher. And we just started one here that is right now coming under pressure. We have the left shoulder here under pressure. It's lower than the right shoulder. Same thing here, because a lot of people are under the impression that if the head and shoulders pattern has the right shoulder lower than the left shoulder, we're in trouble. It can be the case, but it is not always the case. This was the 2009 head and shoulders pattern, and as you can see, this is lower than the left shoulder, even if ever so slightly, but we still resolve to the upside. It's not any different than the NASDAQ here, folks. This shoulder came down lower than this one here. We still resolve to the upside, making new highs in 2020 into the new year. So technicals are not 100% guaranteed. Speaking of the NASDAQ, which now, and I'm almost afraid to look, it's down 260 points here. We're down 25 points here on the S&P 500. It's getting ugly. It's getting ugly here today, midday, just about. Wall Street is going to lunch. You've got European markets are closed. We're losing that much more liquidity and volume in the markets. But here's a look at the NASDAQ composite, and we're throwing off a tremendous amount of, MACD sell signals. The percent of stocks with a MACD sell signal, rose above 40% recently. That's just coming into this week. So you can imagine it's that much higher now with the NASDAQ down significantly here on the week. here we are Friday. A near record percent of NASDAQ stocks triggered a MACD sell signal. Remember, when stocks go on sale, folks, it usually represents a longer term opportunity. Historically, though, for this particular study, when you get to these levels, this led to more gains for stocks over the next 6 months. NASDAQ is up 90% of the time by an average of 15.6%. When you get to these levels, the number of MACD sell signals within the NASDAQ. Here's another chart analysis, if you will, from Ned Davis Research. Based on the selling pressure that has gripped markets since Monday, it's easy to forget just how strong the volume was on Monday, right? Because we rallied 2.3%. The volume was pretty tremendous. Monday was a 13-to-1 up volume day versus declining volume. This is a look underneath the surface. Even though we're going through distribution right now, we're going through price consolidation, the breadth that got us here was robust. It was wide. We were widening out breadth in the market. Again, I could tell you, as long as credit spreads are not blowing out, as long as the yield curve is not inverted, go out there and buy stocks. But these are just another layer of market internals, that tell you how we got to where we are and, how you should view any consolidation. Here's another study of the chart here. And when we get that kind of up volume, it's usually happening at, climactic bottoms in the market. You get these really robust breadth thrust to the upside. And they usually resolved with new highs, new bull market highs. We've seen that throughout this entire cycle. We get these significant breadth volumes and we make new highs. We had one just on Monday, folks. I know it's easy to forget, and we're down for the week and we might be down for the year after today, but it's all of this underneath the surface stuff that doesn't get headlined in the news that you should be paying attention to. All right, here's another study. The largest single day gain for the S&P 500 index, a greater than 2.3% gain that took place above the 200-day moving average, which of course we're still above the 200-day moving average in the S&P 500. We may, get close to that 100-day moving average, but even then we'll still be above the 200-day. So Monday, we had a greater than 2.3% rally above the 200-day moving average. Just another study, this one from LPL Financial. 1 month after this signal, not so good. You should expect some deterioration in the market. By the way, folks, we've already declined 1.9%. Remember, we were up 2.3%. We gave it all back. So we've already overachieved this 1 month return. 3 months later from the signal, however, up 5.6%, but look at the positivity rate. 80% of the time the market's positive. Average return, 5.6%. 6 months later, 100% of the time the market is up. Average return, 11.8%. What breadth tells us is what investors' appetite really is out there. Despite price action, the volume, the breadth thrust, they tell us what the underlying appetite is for risk assets. So we'll keep this one on the board going forward. We've already achieved what you expect to see, which is, some give back, normal and to be expected pullbacks. Monday start to March, another study, akin to what we just looked at there from LPL Financial. The 2.3% gain for the S&P 500 would be the best Monday start to March since last March, when the S&P 500 gained 4.6%. And remember, we had been falling since February 19th back in 2020. this was more than likely a reflex rally, a dead possum bounce. And we know that in hindsight, obviously, because we kept falling in March after this bounce. But look at the 1 month read. This is just March's, folks. This study is all 2.3% gains. This one is just March, to start March. And you can see it's happened a lot. But if we look out, the next day, supposed to be negative, and we were. If we look out the next week, well, we've already achieved that. If you look out the next month, not bad. So just like this particular study here, you know, you should expect some choppiness after such a significant one-day move. We had the non-farm payroll employment today. It was much better than expected. And here, looking at the Stock Traders Almanac, on the March payroll report, well, this is not looking good. The equity market return is supposed to be 0.18% on average and up 71% of the time. This is for the March non-farm payroll report. For the Dow, for the S&P 500, for the NASDAQ, and the Russell. And yet we're in the red, folks. Again, we still have some time here in the trading day, but just some. I don't usually use this kind of a seasonal indicator, if you will, but again, what these tell us, what these give us insight to is human behavior, which is pretty darn constant. Like, this is a good positivity rate. It just speaks to human behavior. You can put any data point you want. We want to know what human behavior is around that particular data point. Speaking of breath, once again, the NYSE stock advanced decline line daily chart. This is the advanced decline line for the NYSE. Here's 2020. And as you can see, we make new highs. This is different. This is very different, this point right here. New highs for the NYSE stock advanced decline line confirms the rally for US equities in February. Here's February, folks. We made a new high. We made a higher high than this high right here. That's different than what happened last February. We made a lower high. The NYSE advanced decline line was still in good shape, but it was a lower high. We were going in the wrong direction. This was late bull market cycle. This is early bull market cycle. We're trending in the right direction. Again, this is beneath the surface. This is another clue as to how you should engage market consolidation. This does not look like this. Cup and handle, right? Cup and handle also, like that. All right, looking good. Consumer discretionary versus the S&P 500. Uh-oh. And here's the problem, right? This is a relative performance chart. Consumer discretionary relative to the S&P 500. And it looks like we keep hitting this ceiling. Now, I don't particularly like to look at it at the consumer discretionary ETF, which is the XLY, because it's cap weighted. And almost 50% of it is tied up between Home Depot, Tesla, and Amazon. I rather look at the equal weight consumer discretionary. Nonetheless, right? This particular chart, when people look at it and they see consumer discretionary waning versus the S&P 500, it's kind of an indication of risk appetite. And some people will even go so far as to say, well, that's a tell on the economy. The consumer's not doing well if they're not spending their discretionary dollars. It doesn't really hold up because of the cap weighting is so heavy in just 3 stocks. One of them, as I just mentioned, Amazon, which, as you can see, has been performing poorly. 3,000 was a floor back in October, here, in November, and more recently, but now it's broken through that floor. As of today, we're down. It broke through it yesterday, but managed to close above it. And right now, 29.21. So it has broken through that floor. And this is the heaviest weighted in the consumer discretionary. It's almost 28%. All right. So looking out further into 2021, everybody's focused on, well, we have a weaker dollar. That's a tailwind for earnings. We have fiscal relief. That's a tailwind for consumer spending, which is a tailwind for earnings. What else do we? Well, we have herd immunity on the way. We're going to have the service sector reopening, and we're going to get employment back. Right? That's why everybody's talking about inflation. We're going to overshoot, and they're concerned we're going to, get beyond the Fed's inflation target of 2%, which doesn't even really exist. They have an average inflation target now, a little below, a little above, and how much time it spends below or above determines what the Fed is going to do with rates. Nobody knows. Nobody knows how long it has to stay above or below. I don't think the Fed knows either. Nonetheless, in thinking about the additional tailwinds, corporate buybacks, as you can see, have been ramping up at the end of 2020 into 2021. Again, another tailwind for those earnings. Right now, the average consensus analyst estimate for 2021 S&P 500 earnings is about $173, $174 a share. Folks, that's going to be way light. Barring an exogenous event, that is going to be way light. We should see that ratchet up, as we go through first quarter earnings and into the summer later this year. Not only that, but companies are sitting on a large pile of cash. That large pile of cash is likely to feed into continued announced corporate buybacks. And that's all we have this week, folks. Thank you again for joining us here for the State of the Market. Come visit us at phenomgroup.com. And if you like this content, hit that subscribe button.